The U.S. markets are currently closed for the post-Thanksgiving holiday break, meaning we're looking at the final closing data from the last active trading session, which concluded on Wednesday. Bitfarms Limited, trading under the ticker BITF on the Nasdaq, closed the last session at exactly $3.10 per share. This represents a substantial intraday surge of $0.33, translating to a massive 11.91% gain in a single trading day. While the markets are silent at this specific moment, the aftershocks of that move are still reverberating through the retail and institutional sentiment indicators. That nearly 12% jump is not just a standard volatility spike, it is a declaration of intent from the bulls in a sector that has been battling compression for months. Most investors look at Bitfarms and simply see a high-beta Bitcoin proxy. The expectation is straightforward. If Bitcoin goes up, Bitfarms goes up more. If Bitcoin crashes, Bitfarms gets decimated. That is the standard retail narrative, the comfortable box that the market likes to put cryptocurrency miners into. However, the reality bubbling under the surface of this $3.10 price point is far more complex and arguably far more lucrative for those paying attention to the structural pivot happening inside the boardroom. The reality is that Bitfarms is no longer just a mining operation, it is rapidly transforming into a hybrid digital infrastructure play that is leveraging its massive power capacity to secure high-performance computing contracts. While the crowd watches the price of Bitcoin to gauge Bitfarms' next move, the smart money is watching the company's transition into AI data center services, specifically the recent developments involving the deployment of NVIDIA GB300 GPUs at their Washington facility. This disconnect between the miner-only expectation and the infrastructure hybrid reality is where the alpha lies. The market is only just beginning to price in this duality, which explains the aggressive bid we saw during the last session. Analyzing the Wednesday session deeply, the volume profile was telling. We saw trading volume that significantly exceeded the 20-day average, indicating that this was not a retail-driven pump, but likely involved institutional accumulation. When you see a stock of this market cap move nearly 12% on elevated volume right before a major holiday, it often suggests that larger players are positioning themselves ahead of a perceived catalyst or news cycle that might break over the long weekend or early next week. The price action cleared several key resistance levels that had acted as a ceiling for the past 3 weeks. Specifically, breaking and closing firmly above the $3 psychological barrier is a technical victory that forces short sellers to reconsider their exposure. In the world of high-frequency trading and algorithmic strategies, holding a short position over a holiday weekend against a stock that just shattered a resistance level is a risk many funds are unwilling to take, leading to a potential short-covering rally that fueled the latter half of Wednesday's move. This brings us to the broader market context. You often hear comparisons to other retail favorites. When you look at Tesla stock or Apple stock, you are looking at companies with massive established moats. Bitfarms does not have that luxury yet. It operates in a commoditized industry where the only moat is efficiency and energy cost. However, the volatility profile of Bitfarms often attracts the same aggressive traders who frequent Robinhood or use SoFi Invest to capture lightning in a bottle. The difference now is the fundamental floor being built by their diversification strategy. Unlike a pure speculative asset, Bitfarms owns tangible power assets, hydroelectric contracts in Canada, infrastructure in the US and Argentina that are becoming increasingly valuable as the global demand for power, driven by AI and machine learning, begins to outstrip the supply. The narrative is shifting from how many Bitcoin can you mine to how many megawatts can you sell to tech giants. This is the angle that the general public is missing. They're looking at the charts expecting a correlation to crypto assets, while the fundamental analysts are running discounted cash flow models based on data center leasing rates. Let's talk about the elephant in the room, or rather, the whale in the boardroom: Riot Platforms. The relationship between Bitfarms and Riot has been one of the most fascinating corporate governance sagas in the sector. We saw a hostile takeover attempt settle into a tense truce, with Riot holding a massive stake in Bitfarms but agreeing to a standstill provision that lasts until 2026. This creates a unique put option under the stock price. Investors know that Riot is watching. If Bitfarms management stumbles, or if the stock price dislocates too far to the downside, the specter of a renewed takeover bid or increased pressure from their largest shareholder returns. This governance dynamic acts as a backstop. It forces the current Bitfarms management team to execute flawlessly on their fleet upgrades and their AI pivot, because they know their job security depends on keeping the share price high enough to fend off cheap acquisition attempts. For an investor using a platform like Interactive Brokers or Fidelity, this adds a layer of game theory to the trade. You aren't just betting on the company, you are betting on the tension between two massive entities. Engagement is critical here because this is a battleground stock. Comment below with your take. Do you think Bitfarms should remain a pure-play Bitcoin miner to maximize leverage on the crypto cycle? Or do you support the pivot to AI and high-performance computing to stabilize revenue? I want to see the debate in the comments section, because this is the central question defining the stock's future valuation multiple. Structurally, the company is in the middle of a massive fleet upgrade. The transition from older miner models to the more efficient T21 and S21 units is not just about increasing hash rate, it is about defending margins. In mining, your revenue is volatile, Bitcoin price, but your costs are fixed, electricity and hardware. By drastically improving efficiency, measured in joules per terahash, Bitfarms is effectively lowering its break-even price for Bitcoin. This means they can remain profitable even if Bitcoin retraces, while their competitors with older fleets might be forced to shut down. This operational leverage is what you look for when analyzing the sector. It is not enough to just have a lot of machines, you need the most efficient machines running on the cheapest power. Bitfarms has historically excelled at the power side of the equation, utilizing surplus hydropower to keep costs in the bottom quartile of the industry. Now, by upgrading the fleet, they are attacking the hardware side of the efficiency equation. Let's look at the technicals on a granular level. The RSI on the daily chart was hovering in neutral territory before Wednesday's breakout, suggesting there was plenty of room for this move to run without becoming immediately overbought. Now pushing closer to the 60 to 65 range, momentum is clearly favoring the bulls, but we are not yet at the euphoria levels that typically signal a local top. The MACD has just printed a bullish crossover, a classic lag indicator that confirms the trend reversal we are seeing in price action. For traders using Fidelity Active Trader Pro or similar advanced charting software, the Bollinger Bands were squeezing tight prior to this move, predicting a volatility expansion. We just got that expansion to the upside. The upper band is now being tested, and in strong trending moves, price can walk the band for days. The immediate support level to watch is the breakout point at $2.85. As long as the stock holds above that level on any pullbacks next week, the bullish structure remains intact. However, we must address the risks, because blind optimism is the fastest way to lose capital. The Bitcoin halving economics are still playing out. With the block subsidy cut in half, miners are fighting for a smaller pie. If Bitcoin price does not sustain a trajectory that offsets the production cut, miners with higher administrative costs will bleed cash. Bitfarms has historically been prudent with debt, but the capital expenditures required for both the fleet upgrade and the new AI infrastructure build-out are immense. We are talking about hundreds of millions of dollars in CapEx. If the execution is flawed, or if the AI contracts do not materialize as fast as projected, the company could face a liquidity crunch that would force shareholder dilution. Secondary offerings are the bane of mining stock investors. You see your stake diluted overnight to pay for new machines. While Bitfarms has a strong balance sheet relative to peers, the cash burn rate during this transition phase is the metric you need to watch like a hawk. You can track these metrics easily on financial portals like Schwab Intelligent Portfolios or Yahoo Finance, but you need to look specifically at the cash flow from operating versus investing activities. The macro environment also plays a massive role here. We are looking at late 2025 economics. The Federal Reserve's interest rate policy is the invisible hand guiding this ship. If rates are trending lower, growth stocks and capital-intensive industries like crypto mining benefit disproportionately because their cost of capital drops. Lower rates also typically weaken the U.S. dollar index, which